Thanks, Ulrich. So part of my job is to find new ways to explain this technology, and the way I'm going to explain it to you today is also specifically formulated for this audience. So think of the way we used to transact, or the way we transact digitally today. If I have a shop and someone comes to my shop and he swipes his credit card buying something from me, then there's a ledger that's updated, and money is deducted from his account and it's debited to my account. And the bank knows both of our identities in this transaction. So should one try to cheat the other, then the bank will intervene. Now, if I try to pay someone digitally without a bank, let's say I have a picture of my dog, and it's a nice dog, it's a nice and healthy dog, so I have some sort of inherent value which I attach to that picture and I email it to someone else's payment. The problem with that is I still own a copy of that picture. And I can then pay 1,000 people with the same picture. So digital data in itself is valueless. I can spend my whole life writing a report and doing research and writing a report, and then sending that. I can send that report to someone else. That person can just make 1,000 copies of that report in a few seconds, and suddenly there's no value anymore to it. The information inside the report is valuable, but the digital data itself is valueless. So since 2009, that has changed. Satoshi Nakamoto, through the publishing of the white paper for Bitcoin in 2009, combined three technologies: proof of work, consensus algorithm, and a blockchain. And through the use of those three technologies, we can now make digital data scarce. So, what does that mean? Well, I can now send a picture of that dog to someone else, and I cannot claim ownership of that picture anymore. It is undisputed that I am not the owner of that picture anymore, and that the recipient of that picture is now the owner. So digital data can now be scarce and can be valuable. So what does that mean? Well, now we can write a piece of software that attaches a monetary policy to that piece of digital data, and we can call it money. As you know, money needs to be durable, fungible, medium of exchange, store of value, and a few other things, a medium of account. And we can program all of those attributes into this piece of digitally scarce data. And as you know, that fiat money as we know today is quite mediocre in all of those attributes. We thought it's a good store of value until the day our finance minister got fired. And then we realized overnight that it's not such a good store of value. We thought that it's durable until you go into Africa and you have a $100 note with a tear in it. Then suddenly no one wants to accept it anymore. We thought it's fungible. But if you don't have small denominations of notes, of dollar notes in Africa, then the merchants also don't want to accept it because they don't have change for it. So it's not that fungible anymore. A $100 note might be valued a little bit less than $100, and a $10 note might be valued slightly more than $10. So our assumption that money has to adhere to all of those attributes is actually challenged. If you think about it, we can now program a piece of digitally scarce data to be an excellent store of value but a terrible medium of exchange. Or we can program it to be not so fungible but an excellent medium of exchange, or a terrible store of value, or anything like that. We can literally do anything with this digitally scarce data. So we'll be talking about the regulatory environment around crypto today and the energy usage of Bitcoin and so forth and so forth. But in my opening remarks, I'd like to point out that the assumptions that you have, that we as humans have, around how money works and how this technology should be treated, all of those assumptions will be challenged. This technology is borrowless and it's permissionless in its nature. And that will literally challenge every assumption that we as humans have about economic policy.